Hey everybody, just an update. Lots going on. The Treasury Secretary Scott Bessent has intervened in multiple markets here recently, and it's having significant effects throughout the markets and the economy and all the components. So, just wanted to give you an update as to what's going on. First, he intervened in the Japanese yen, which I noted earlier in one of my updates, and that had started the rally in gold and started bringing the Japanese yen, appreciating the Japanese yen, so it wasn't quite so weak, and was creating some effects of moving worldwide interest rates higher. And so he sold the euro, which the European Central Bank and European leaders did not appreciate, because normally they're supposed to give them notice, and they did not. Sold some of the euros that they had and bought Japanese yen to increase the value of the yen versus the dollar and the other currencies. And so that was the first shot across the bow that the Secretary of Treasury is going to intervene to help our economy and our markets. And then just recently this week, he said he was willing to buy longer-term Treasury bonds that were less liquid and selling short-term Treasury bills, which kind of liquefies the market. It does make the market more dependent upon the Treasury, although the amount of money that he committed, initially it was up to $4 billion, and then the next day he said, oh, I'll go more than that, because it didn't really help, and the interest rates continued to go up. And so he's trying to keep the interest rates from continuing to rise. The 10-year Treasury is hitting higher levels again, and bumping up against high levels over the last year or two in the 4.7275 range, which is bringing mortgage rates up to the 6.8 range and starting to cause some effects on the real estate market. So anyway, the fact that he's doing these things, it's technically not quantitative easing. It technically is not stimulating the economy, although it can be said the consequential effects of it can, meaning bringing long-term interest rates could stimulate the economy, although bringing them down, although it really hasn't. It did for about half a day, and then it is kind of expired because it's not a huge dollar commitment, and it really was a sign of his willingness to do these things, which he's telling the markets, hey, be careful, I'm out there when it comes to the Japanese yen, so don't be short in the Japanese yen to excess, and don't be short in the bond market in the long end to excess, driving interest rates up. So really what one of the main things that the press has not been talking about is one of the main things that driving interest rates up is, yes, the debt's high and all that stuff. Yeah, it's been that way for 10 years, 20 years. So that excuse really doesn't fly. But it's oil prices are going back up. And as we remember during the war, interest rates started going back up a lot when oil prices started going back up. And since Trump is now trying to tighten the economic screws on Iran, that is driving interest rates up as Iran is starting to struggle with revenue because they're not able to fill up any of the ships. The U.S. military is stopping their ships from filling up, and we're also trying to keep other countries from buying anything from Iran. So, an interesting tactic, maybe better, maybe worse, who knows? Than military, at least people don't get bombed out from that, so that's a good thing. But this war is obviously a lot more of a problem for Trump than he ever anticipated, I would say, and is becoming a bit of a quagmire. So how he gets out of this, I'm not going to comment on, because I don't know and no one knows. But ultimately, it is driving interest rates up. But all this interaction by the Treasury has really created a bid for gold. And like I had told you a while back, two of the three of my indicators had put in buy indicators on gold. I hadn't really bought in yet, and I still haven't bought in yet too much. I had some exposure, but I'm expecting the next week we'll have another full-fledged buy signal on gold. And then we did get a full-fledged buy signal for up to 100% of your allocation of what you want to own in Bitcoin. So that is what is going on with those markets. And Bitcoin has gone up from low 60s all the way up to 77. I think it may have hit 80,000 yesterday. And where it might go, it might correct. But it is broken out of its long-term consolidation in the low 60s. And so that is a positive indicator for Bitcoin. And with the government getting involved in the economy, that is boosting, it's trying to boost stocks. I don't know, we are still only 50% allocated. I'm only 50% allocated in my allocation for stocks. So there's still some things that aren't looking good in momentum and everything in the stock market. So there's still a chance of a decent sized correction, but who knows where that will go. But Bitcoin back in, adding some extra to my base holdings of Bitcoin, and then waiting for gold to have a full-fledged indicator. But do as you like. Obviously, it's not financial advice, but gold has moved from low 4,000s to 4,500-ish, and has broken through some resistance. There's still another level, and I think that's what the last major indicator is looking at, to see if it can break the 200-day moving average and whatnot in order to make its full rally. I think with all the altercations in the world, the central banks, China's been piling on the gold in the last 3 quarters. They have been adding more each month to the reserves. They're smart buyers. When prices collapse, they buy. When prices go up, they may be selling, but they stop. They don't buy at high prices. They're very good investors when it comes to long-term looking at that stuff. They accumulated oil when it was cheap, and now they've cut their economic consumption of oil dramatically. And that's why the Strait of Hormuz was such a surprise that it has not caused massive stress on the oil systems throughout the world, because China's usage has dropped dramatically with the implementation of all the electric cars, and they haven't needed to buy as much in the market, because 50% of the oil use was coming from the Strait and from Middle East. So they've been able to use the reserves. They have over a billion gallons of oil in their strategic petroleum reserve. We don't know the real numbers, but they're massive. And so they haven't had to buy nearly as much oil as they think. They've intentionally shrunken their economy to reduce the stress in the oil markets, and they are accumulating gold, while gold went down from 5,500 down to 4,000, or just below 4,000. So making smart moves, something that is worth looking at, as I believe gold is going to be an amazing long-term investment, especially if the government is going to have to print to keep interest rates down, but potentially the Fed might get involved in keeping the longer-term interest rates down, and that is more stimulative to the economy than the Treasury doing it. So anyway, a lot of stuff going on, and a big effect. The real estate market is slowing. July was a bit weak, and pending home sales was really weak in July. As we talked about, the employment component in June was of the economy, or in July, was also very weak, with lost jobs. 1.4 million people dropping out of the job market, and they're not counted anymore. So hey, they're not unemployment. So unemployment's at 4.1 or 4.2%. Woohoo! Yeah, but the fact that people are dropping out of unemployment is not a good sign. So. And then 900,000 full-time jobs have vaporized just this year alone. So the continued slowdown in the job market is continues. Not tragic, but it is an issue, and is reflective of the AI dominance. Right now, AI is out of control, going on to the private equity and private market. NVIDIA had to bring in Apollo and all these bankers, Goldman Sachs, and the Blackstone folks, all to try to drum up another special purpose vehicle. I mean, I'm not making this up, to come up with a loan system of $500 billion to lend to people that need to buy NVIDIA products. Okay, talking about circular financing, we are in this world that NVIDIA realizes if people stop buying their stuff, this whole house of cards will collapse. When this house of cards will collapse, we don't know, but it is something that will happen. It has happened every time when we had a massive capital build out, whether it's railroads, internet, automotive, whatever it is, there's a crash. And there will be a massive crash from this. And how well contained it will be, I think it will probably be very bad, just because the private credit, it's involved in insurers, life insurance, private equity. It is so deep. Like they're selling, Mark Walters selling parts of the sports team he owns because he's in trouble. So there's so many things going on with all these private equity funds that you don't really hear about because of all the other news that's going on. But it is really ugly, and it started a year ago with Tricolor and all the companies, the private equity companies that were going bankrupt, and it is continuing. And with Nvidia and other companies borrowing money, Oracle borrowing more money to fund this AI build out. And so, like, you lend the money. It's very similar to the 2008, or excuse me, to the 2000 internet build out when you had the companies selling routers. Cisco selling tons of routers out there and financing the sale of the routers so that more people could buy more routers, so that they were giving cheap money for that. So as interest rates continue to go up, the money's getting more expensive. So NVIDIA is trying to drum up ways to create these funky loan programs to lend to their customers to buy their stuff. So really circular, really not unusual. It happens every big boom that we have. It is human nature, and it will blow up. The question is when. It could go on for 2 months, 2 days, or 2 more years. But that's why my equity exposure is designed to cut off the potential downside. Because remember, if you lose 50% in the market, and at me at almost 60 years old, if you're nearing retirement or anything over 50 years old, if you lose 50% in your ownership and the hold for the long term, you are in trouble because you got to double your money just to break even. Remember in 2008, after that crisis, things didn't, I mean, for 2001, after the stock market collapsed, you didn't get even for, I think it was 14 years, something like that. You didn't get even again. So it is very dangerous to lose a massive part of your savings. And so to accumulate wealth on top of your savings at a higher level. So yeah, you might not get as many gains, but you, each time, if you gain 5%, on your, say you have $100,000 saved, as opposed to 50,000 after a crash, you're going to be much better off accumulating savings at a higher level. So anyway, that's what we're doing. Bitcoin ownership is recommended from my indicators is back to 100% level. Now that may only be 5 or 10% of your total portfolio. I'm saying of your allocation. And that I would take over this week and next week. It's usually you got to do it relatively fast because it's a fast moving component. And then gold, waiting to hear from more indicators. But if you want to get in, there's certainly been indicators. I wouldn't be surprised. It's a little overbought right now. If there's a pullback, it might be really short-lived. And each time it looks like it's going to pull back, it takes off another $100. So who knows what's going to happen there? But a lot of people are moving back into the gold market because of what the government's doing. So this intervention is probably only beginning. And with the elections coming in, and then a potential market distortions and problems over the future because of our debt and because of our expenditures, it is going to be a wild ride for the next few years. So anyway, stay tuned and make sure you subscribe, tell your friends, and we'll catch you later. Have a great rest of the weekend, and we'll update you when any changes to the portfolio happen. Take care. Thanks.